Howdy, Jacob here. Today we're looking at Collegium Pharmaceutical in the pharmaceuticals industry. Who'd have thunk? 1.1 billion market cap on 1.3 billion enterprise value. They are a specialty pharmaceutical company that engage in the development and commercialization of medicines for pain management. Okie dokie. Founded in 2002, but didn't make any revenue till 2016. They were a cash burning company, but they're starting to make some money now with very dampened gross margins, but their operating margins 29% in the most recent year. Not a long history of profitability here, and that's kind of difficult to manage. R&D spend was zero the last year, so they actually removed all their research and development spend, but they made money 3 of the last 4 years. And on the cash flow side, it's a bit more impressive. Probably helps that their capital expenditures are zero and their depreciation, amortization, and stock-based compensation are pretty hefty, to where 1, 2, 3, 4, 5, 6 last 6 years produced a very solid amount of free cash flow. Their use of free cash flow is investments in both intangibles and hard assets, and then repurchasing of shares, paying down some debt here. A pretty big net acquisition, but really just one in the last 10 years. So kind of all over the place with capital allocation. They have about 250 million. Whoa, way off. 311 million cash-like products, 183 million short-term debt, 484 million long-term debt. So they have enough cash for that short-term debt, not concerned about that. And then 484 million in long-term debt. They produced 308 million in the last rolling 12. So not terribly concerned with that debt. It looks like they are paying down the debt from this acquisition, and it does look like that acquisition gave them positive earnings and free cash flow. So that could be good news for them. But I think I'm ready to make some assumptions here. This could be kind of interesting. So the revenue growth side, really all over the place. I don't know, maybe 7%. They look for a 17p price to free cash flow. The margins for free cash flow, 30. Let's do a big range here. I don't know, 7% revenue growth. I don't know. Let's do 5 and 15. Maybe. And then the share change, they're buying back some shares, but they're issuing a bit through stock-based compensation. Issuing 29 would be about 2%. They can pretty much offset that. So really it's just these margins, how comfortable are we that they're able to hit these type of margins, especially on the earnings side. But free cash flow is more so the lifeblood of the business. So we'll see how appropriate this depreciation amortization figure is, because 146 million of depreciation and amortization with a 567 million revenue. That's crazy, with a balance sheet of, okay, interesting. So yeah, I definitely want to look more into what all they're depreciating, because that is very hefty. But just based off the numbers, it looks pretty solid now. So this will definitely require more research. And I hope you enjoy the video and have a great rest of your day. Thank you.